Now we discuss lecture number 39, moving average, convergence and divergence. As it is the most important lagging indicator that we are studying technical indicators. Moving average, convergence and divergence is basically using the moving average to get into a conclusions. As we already discussed, the lagging indicators uses the moving average and the leading indicators uses the rate of change. That means they measure the momentum. Whereas the moving average, convergence and divergence is all lagging indicators measures the trend strength. Moving average, convergence and divergence is a trend following momentum indicator that shows a relationship between two moving averages of a security price. The moving average, convergence and divergence is also called as MACD, that is MACD, is calculated by subtracting the MACD is calculated by subtracting the 26 period exponential moving average from the 12 days or 12 period exponential moving average. The result of that calculation is moving average, convergence and divergence line, that is also called as MACD line, and 9 days EMA of MACD called as signal line, that is very useful for the purpose of getting a signals of a crossovers. If the signal line cross the MACD line, it creates a signal. Traders may buy the securities when the MACD line crosses the above the signal line and sell or short the signal or security when the MACD cross below the signal line. The moving average, convergence and divergence indicators can be interpreted in several ways, but the more common method are crossovers, divergences and rapid rise and falls. With these all three common methods to interpret the MACD, we have to discuss in detail. First, we understand how the MACD work by the help of an example chart. You see an example chart on your screen. You easily identified that in the above upper part we have a price and we draw two moving averages, and in the lower part we draw a MACD indicator. Whenever the price move upward in a strong form, the two averages difference is getting broader, and these two indicators or the broader difference between the two moving averages is read by a MACD line. You easily clearly see in the month of May in the chart the MACD line is much more far than the signal line. When the price is getting consolidated or flatter in the month of June, the MACD line crosses the signal line, and that creates a crossover. This crossover clearly signifies that the trend is reverse or there is a profit booking in the trend. After some time, when the price get bottom out in the month of near about July, the price again, the moving MACD line again crosses the signal line and the trend is again moved to upward. Please identify at the month of August, the MACD line just kisses or touches the signal line, which show a very good strength for the buyers. As we discussed earlier, we can use the MACD indicator for three purposes: crossovers, divergences and the overbought and oversold zone. Please keep in mind that don't use MACD indicator alone. Always use some of the momentum oscillators to get better confirmation with the MACD indicators. Now we discuss crossover in detail. There are two categories of crossover in MACD. The first is bullish crossover and the next one is bearish crossover. Now we discuss bullish crossover in detail. When the MACD line fall below the signal line, it is a bearish signal, which indicates that it may be time to sell. In the vice versa, when the MACD line rise above the signal line and indicates that a bullish signal, due diligence is required to rely upon these common signals. Traders will often use or combine this analysis with a relative strength index or other technical indicators to verify the overbought and oversold condition. By the help of this sample chart, you can easily identify how you can use a MACD indicator. We easily see that after the month of October, the stock picking a very good momentum, and in the month of December, the MACD line crossed the signal line and it shows a positive momentum. But you easily understand that when the price after the month of December is in a consolidation form or in a downward, again the MACD line crosses the signal line. So please remember that if MACD line crosses the signal line in a constant manner, that pattern or the time frame is consolidation phase. So please think that every crossover is not the reversal one. You have to confirm with other indicators or look after the price whether the price will not move into a consolidation. Now we think about the bullish crossovers. If the MACD crossover below the signal line following a brief move higher within the long-term trend, traders will consider that will be a bearish confirmations. Due diligence is required before relying on these common signals. Traders will often combine this analysis with the relative strength index or other technical indicators to verify the overbought or oversold zone. With the help of a sample chart that you show on your screen, in the month of May or June, the price will go down and the MACD line crosses the signal line to confirm the crossovers. Please identify that MACD crossovers many of the time will create a false signals. We can easily identify the overbought and the oversold zone by the help of MACD. When the MACD rises or falls rapidly, the shorter term moving average pull away from the long term moving averages. It is a signal that the security is overbought or oversold and it will soon return to the normal levels. Traders will often combine this analysis with the relative strength index or another technical indicators to verify the overbought and oversold conditions. As a sample chart you see on your screen, you can easily identify the overbought when the price move very fast or rapidly from absolute bottom in the month of Feb or between the Feb or March, and when the prices rise in a very rapid manner, the MACD will automatically come in a overbought zone, and this overbought zone is again reconfirmed by the help of RSI. The RSI is again above the 70 levels. By the help of these both levels, we can easily identify that now the trend is getting weaker or it come to the center part. People use moving average conversion divergence exclusively for the purpose of divergences. We can easily define bearish and the bullish divergence, the two categories that you use in MACD. First we discuss the bearish divergences in detail. As we see the price move on upward and the right horizontal line will clearly signifies that price will create a new high, but in the same time the MACD line creates a lower tops or a lower throws. That clearly signifies that there is a bearish divergences. The MACD divergences are very important across all technical indicators. The bearish divergence or the bullish divergence in MACD will sustain for a longer period of time. Now we discuss the bullish divergences in detail. When the MACD forms a highs or lows, then divergence corresponding higher highs and lows on the price called as divergences. A bullish divergences appears when the MACD forms two rising lows corresponding with two falling lows on the price. By the help of the example, we can easily understand the bullish divergence. As the sample charts show on your screen, we can easily identify the bullish divergences. Between the month of May and July, the price create a lower lows or create an absolute bottom, whereas the MACD line creates a higher bottoms. That means there is a clear divergence between price and a MACD line. And by this action, the price will move upward. So by the help of this both charts, you can easily identify the bullish divergence and the bearish divergence. We can brief the MACD uses in a very 3 points. The first important point is crossover. The MACD crossovers are many of the times are not accurately work. So always use RSI along with MACD to get a proper crossover. If the RSI is overbought or oversold and moving average give you a crossover, that is the best identification of trend reversal. The second thing is overbought and oversold. Many of the people in the MACD will not use overbought and oversold as a good confirmations. The third one is divergences, and I personally believe that MACD is exclusively used for divergences. The MACD divergences are very stronger and sustained for a long period of time. So always use bullish or bearish divergences from the MACD indicator.